Welcome. Today's Thursday, September 21st. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and editor of Alpha Insights. And this is your Daily Five. Daily Five is the show where we go through our top 5 charts of the week. These are the charts that are most important to us. But before we jump into that, I just wanted to alert folks that our next publication of our investment newsletter is slated for October 7th. If you're not familiar with the newsletter, we do publish a monthly newsletter. It's available on Substack. It's free to subscribe, and it's delivered to your inbox via email on the first Saturday of each month, usually following the NFP report. The newsletter is affectionately entitled Huge Insights, the Big Picture. Therein, we discuss the key macro factors affecting the economy and the markets. And believe it or not, we do get some inquiries from folks from time to time who want a little bit more. And so we've actually created an option to upgrade to paid for as little as $12.50 a month. And that allows our subscribers to access our monthly market forecast and positioning recommendations. Our paid subscribers actually also receive a weekly publication called Alpha Insights Idea Generator Lab. That's an institutional publication, typically reserved for our investment strategy clients. And it details our top actionable trade idea each week, usually a stock or an ETF that we think has strong promise, a fat pitch, if you will, and also updates our market commentary with a kind of a midweek view of what we think is going on in the market. And we also provide these paid subscribers with additional access to quarterly video content and interim bulletins from time to time as well. So there's a lot of value there for $12.50 a month. If you're interested in upgrading to paid, give it a shot. What do you have to lose? $12.50 a month. That's it, right? Let's jump into the first chart. I wanted to kind of review investor sentiment. It continues to remain ebullient, to say the least. We just presented this slide a week ago at a conference in Dallas. And based on bottom-up EPS revisions, it looks like Wall Street analysts are more bullish today than at any point in the last 12 months. In fact, investment advisors, people like myself that publish investment newsletters, for example, are also pretty bulled up across the board. According to Investors Intelligence Advisor Sentiment Survey, using the 4-week moving average of the ratio of bullish advisors divided by both bulls and bears, that remains at a very elevated 68%. That level's just below the 72% level that prevailed back at the peak of the market in late 2021, early 2022. Also, last month, the month of August, saw institutional portfolio managers experienced the largest increase in net buy transactions since December 2020. We also saw about a 12.3% uptick in the State Street Investor Confidence Index. So this suggests that institutional investors are going all in here on a view that we could get either a soft landing or a year-end rally. Clearly, there is a lot of catch-up to be done by institutions that are trailing their benchmark. And finally, option traders have been the most complacent that they've been since really the NASDAQ complex topped back in November of 2021. This chart is actually a few days old. It reflects the lows that we saw last week. And in fact, hasn't changed all that much, although it has ticked up in the last couple of days as the markets come under pressure. But the bottom line is this: when broad-based investor confidence across, Wall Street analysts, newsletter advisors, institutional investors, and traders are all as confident as they appear to be in these surveys and indicators, it has historically attended very important market tops. And that is the point that we're trying to make today, is that we think we're very close, if not at a significant turning point in the market that could be carrying the averages down substantially. Now, another indicator that seems to be indicating that this is the case is market breadth, which appears to be very narrow right now. In fact, over the past year, there's been a rather pronounced bifurcation in performance that can be observed across a broad mix of key market indexes. Perhaps most noteworthy is the shift away from small cap and value segments of the market into mega cap growth segments of the market. Now, if this were a new bull market, we would expect to see small cap and value and the junk stocks, so to speak, leading the market, leading the charge off the lows. But in fact, what we see is a highly concentrated market that is focused on, the very highest quality, strongest growth companies with fortress balance sheets. And in fact, the widely pronounced double-digit gains of the major indexes have been driven by just a handful of stocks, widely referenced these days as the Magnificent Seven. This is the Apple, Microsoft, Amazon, Google, Tesla, NVIDIA, Meta complex that seem to be, attracting all of the fund flows because of their quote unquote growth characteristics and association with AI. Indeed, if we take a look at kind of the contra trade, that would be the banks index, which has lagged severely, down some 23% over the last 52 weeks. And in fact, small caps and value stocks are also negative if we look at the S&P 600 and the value line geometric index of about 1,700 stocks. These indexes are negative over the last 52 weeks. Even the equal weight S&P 500 is only up about 1.4% over the last 12 months. Now, historically, when the market's leadership becomes this narrow, this concentrated in just a handful of stocks, a single, factor like growth, mega cap, this signals an underlying condition of weakness in the broad averages, and it typically precedes a major trend reversal. We've titled slide number 3, Crude Realities, and we're showing a chart of, it's a P&F chart. If you're not familiar with point and figure analysis, it is an arcane art of charting that dates back to, many, many years ago. I think the 1950s. One of our mentors, Alan Shaw, was one of the foremost experts in this art, and he's written a book on it, which we read and studied and became familiar with this process of analyzing charts using X's and O's. And without going into great detail, we would just simply say that the chart of WTI crude appears to be pointing to significant upside potential from where we are today. Now, this chart's a couple days old, but it hasn't changed at all. The target that the chart is forecasting is upwards of $114 a barrel. Now, WTI crude inventories in the U.S. have fallen to just 46 days. That compares to the long-term average of around 65 days, and it is actually the lowest level in over 4 decades. Now, meanwhile, world oil demand just posted a new all-time record high in August. So we've got a supply and demand imbalance, which fundamentally suggests that crude oil should see price pressure to the upside. And as such, it's really no surprise that WTI crude prices just posted an 11-month high on Tuesday at $92 a barrel. Now, attending that is, according to AAA, the national average gasoline price reached $3.86 last week. That level, we think, could go significantly higher if WTI crude prices do reach the P&F price target of $114 a barrel. And in fact, gasoline prices have an outsized influence on inflation expectations, and 10-year Treasury yields are very positively correlated to those expectations. Which brings us to slide number 4. Treasury yields are breaking out this morning in a very big way. We just hit the highest level in the 10-year Treasury yield since 2007. So if the 10-year yield has broken out to the upside and it sustains, we think this bullish inflection above 436 projects at least a small measured move up to around 467, but then a potentially larger measured move to 495, and then finally 533. Now, it's anybody's guess as to when we might achieve those levels, but I think those levels can be achieved, kind of systematically over the course of the next 3, 6, 12 months, if you will. But I would actually direct your attention to the move index in the lower frame of the chart. Now, the move is kind of the equivalent of the VIX, but for the bond market. And what we see is that the move index is actually testing its February low and is really nowhere near the past peak levels that have coincided with every downside reversal in 10-year note yields over the past year. So for those who are saying that, this spike up in 10-year yields is going to be short-lived and it's going to reverse, we don't think that's the case. It's certainly not being reflected in the volatility study. In fact, we believe that a 30 basis point, bump to 10-year Treasury yields, pushing 10-year yields to potentially as high as, say, 467 in the very short term, could very well be a catalyst for the stock market weakness that we have been expecting. And in fact, we published another Your Daily 5 video presentation back on July 27th, where we called basically for a major trend reversal. And that seems to be unfolding exactly as expected, and has unfolded as rates have been moving higher during that period. And I think that could continue to be the case here. And the higher the move in yields, the greater the magnitude of the decline in stocks is probable. Now, we've been showing these next few slides of the S&P 500 for some time, going back, I think, to January of 2022. We can look at the 14-year monthly view of the S&P on the left-hand side of the screen. And that really looks at what we've described as cycle wave 5. This is the 13-year advance off of the 2009 low that peaked in January of 2022. And we think that top ended cycle wave 5, and by extension, super cycle wave 3, and that the decline off of that level was really just the initial decline of a 5-wave impulse pattern that we think will ultimately culminate in cycle wave A down of super cycle wave 4. So as we've kind of traced it out, and you can look at the blown up, zoomed in view, if you will, the 4-year weekly view on the right-hand side of the chart, the decline off of that January 4th, 2022 high in the S&P traced out 5 waves in what appears to be an expanding leading diagonal pattern to end what we've labeled primary wave 1 down on October 13th of last year. The advance off of that October low appears to us to be counter trend, and we count it as an ABC zigzag. That zigzag, traced out, a flat wave pattern in its kind of middle segment, which did throw off a little bit of confusion in our analysis initially, but we did recover here, and we think that the advance off of the March lows, the B wave low of that flat, traced out 5 waves into the July 27th high to complete primary wave 2. It retraced about 84% of the preceding decline, but topped just shy of the intermediate wave 2 high in primary wave 1 down. And so that is not unusual for a counter trend off of that expanding leading diagonal pattern, which, by the way, is rare. So there's not a lot of history on this, but certainly, meets all of Elliott's rules and guidelines in terms of a second wave advance. And from that July high, we believe that the market is now tracing out its very early subdivisions of what will ultimately be primary wave 3 down. Primary wave 3 down has the potential to carry the market down into the mid 2000s. We think S&P 2775 is our minimum downside target for primary wave 3. But if we just flip back over to the left-hand side of the chart, you can see that primary wave 3 doesn't end the decline. It'll be followed by primary wave 4, which will be a shallow counter trend advance in our estimation, and a final plunge into primary wave 5 to end cycle wave A. Cycle wave A will be followed by cycle wave B, another counter trend advance, which could retrace somewhere between 1/3 and 2/3 of the initial decline. And that will be followed by cycle wave C down to complete super cycle wave 4. we believe that this entire process could take over a decade to trace out. In fact, the arrows are just to kind of give you a directional sense of what to expect, not a timeline. So we are not predicting this to happen by, say 2026 as the chart would, suggest. We would suggest that it might take as long as, say, a Fibonacci 13 years to complete this entire process of supercycle wave 4. So we would prepare ourselves as investors to live through what could be a fairly difficult time for equity investors. And that's what leads us to believe that, T-bills are really the best place to be putting capital right now. You can earn the equity risk premium of 5.5%, basically risk-free, and sit on the sidelines and avoid what we think will be a catastrophic event in equities over the next decade or so. But, let's focus for the next couple minutes here on what we think is happening near term. This is our short-term Elliott wave analysis. And as you can see, this chart is a 120-minute bar chart looking back about 4 months or so. And what we can see is since July 27th, the peak of primary wave 2, the S&P has traced out an impulsive 5-wave decline, which we've now labeled minor wave 1 down. That bottomed on August 18th. And it subsequently was followed by a very low volume 3-wave counter trend advance, which took on a simple zigzag ABC corrective waveform. The rally retraced approximately a Fibonacci 76.4% of the preceding decline. And the decline below what was minute wave A here actually confirms that the top is in for minor wave 2. So this September 1st peak right there, that was the top of minor wave 2 down, or minor wave 2 up rather. And as such, we are now in the initial subdivisions of minor wave 3 down, which at minimum, in our opinion, should carry the market down here into this gap support range of around 4240 to 4220. Now, so far, we've counted 5 waves down, minute wave 1, a 3-wave corrective waveform to complete minute wave 2 on September 14th. And from that point, we are now tracing out what will likely be minute wave 3 of minor wave 3. And that suggests to us that minor wave 3 can carry considerably lower. In fact, I think it's important to point out that we're also seeing the development here of a classic pattern top formation of the head and shoulders variety. This is your left shoulder, this is your head, and this is the right shoulder of the formation. A breach below this neckline that connects these prior lows here would actually resolve this head and shoulders topping formation and project a measured move down to as low as 4,050. 4,050 would take out the 4,200 and 4,100 levels that we think are very, very important to defining whether or not this is indeed the beginning of primary wave 3 down. It would eliminate any bullish wave counts once we close below S&P 4,100. So if in fact this pattern does resolve to the downside, we think there's a very good probability that it will carry into that 4,050 level. And that should probably terminate what will ultimately be intermediate wave 1 down of primary wave 3 down. And so if we just flip back really quickly, that would get us somewhere into around here. And we think once we break below these levels, the market will wake up to the fact that there's more to this than meets the eye. We are expecting this decline to carry down into this 2,700 range that we put in. That's about a 50% retracement of the entire advance here. And once we get there, again, we'd see a shallow counter trend advance and then a final plunge down into what we think will end cycle wave A. That coincides with the 61.8% retracement of the entire cycle wave 5 advance, a prior 4th wave low, and the 200-month simple moving average. that culmination of support seems like a logical place for cycle wave A to find support, and for cycle wave B, the subsequent counter trend advance, to begin emerging. So again, we expect this to extend out for years. We do not anticipate that this is going to be a quick, couple years sort of scenario. We think it's going to be a decade-long process. And so we would encourage investors to batten down the hatches, to move to the sidelines, and to increase their cash reserves dramatically and earn the equity risk premium risk-free by owning 3 to 6 month T-bills at 5.5% right now. With that, if you have any further questions or want to follow up with us anyway, you can certainly go to our website, jwhinvestment.com. We're on Twitter, and you can follow our work there as well at alpha_insights. And finally, if you'd like to follow us on our newsletter, you can sign up at hugeinsights.substack.com and get the newsletter delivered directly to your inbox the first Saturday of each month. With that, I would like to thank you very much for watching and wish you the best of luck trading.